Ever wondered how the ancient practice of temple banking evolved into the sleek, digital financial systems we use today? In today's video, we'll unravel the fascinating transformation of banking, from its early roots in ancient temples to the revolutionary fintech of the 21st century. How did banking start? The origins of banking can be traced back to around 2000 BC, when ancient merchants started offering loans to farmers to buy grain, and traders began transporting goods across Assyria and Babylonia. This period marks the dawn of an intricate financial system. The Code of Hammurabi, from 1772 BC, provides a fascinating glimpse into early banking practices. It is one of the earliest comprehensive legal documents detailing contracts, loans, interest, and collateral, paving the way for organized financial transactions. As civilizations advanced, banking became more sophisticated. In ancient Greece and Rome, temples emerged as early banking hubs where people deposited money, took out loans, and even had their coins tested for purity. Greek bankers further revolutionized the field by facilitating book-based transactions, enabling credit transfers between cities without physical money exchange. The modern banking system began to take shape during the Middle Ages and Renaissance in northern Italy's flourishing cities, Florence, Venice, and Genoa. The spread of banking across Europe saw significant innovations, particularly in Amsterdam during the Dutch Republic's Golden Age. By the late 17th century, London witnessed transformative changes in the banking industry, setting the stage for contemporary finance. Before money, trade relied on barter and gift economies. Bartering, one of the oldest trade methods, involved exchanging goods and services directly without money. Despite its simplicity, the barter system persisted even after the invention of currency. The gift economy, where goods and services were exchanged based on social norms rather than monetary transactions, was prevalent before market economies took over. While bartering was not the dominant form of trade, early societies often operated on debt and gift-based systems, with bartering typically occurring among strangers. Banking's early beginnings. It all began around 2000 BCE in Mesopotamia, where temples, the earliest banks, managed deposits of grain and valuables. Priests, acting as the first bankers, lent these resources to farmers and merchants, laying the foundation for bookkeeping. By 600 BCE, Athens was shaping modern banking with its introduction of standardized coinage, a revolutionary step that boosted trade and banking. The Romans built on this, creating a sophisticated banking network across their empire and pioneering innovations like bills of exchange to facilitate fund transfers across distances. Medieval and Renaissance Europe. The medieval era saw a resurgence in banking, largely thanks to the Knights Templar. Their secure storage and fund transfer systems for pilgrims laid crucial groundwork for future banking practices. The Italian city-states of Florence, Venice, and Genoa became banking powerhouses in the 14th and 15th centuries, with the Medici family leading the charge by popularizing double-entry bookkeeping, a key accounting practice that endures today. Modern banking took a giant leap forward with the establishment of the Bank of Amsterdam in 1609. It acted as a central bank, stabilizing currency and setting a precedent for future institutions like the Bank of England and Sveriges Riksbank. The expansion of banking. The 17th and 18th centuries heralded the rise of banking dynasties such as the Rothschilds and Barings, and the emergence of joint stock banks, which allowed for public investment in banking. The New World joined the banking revolution with the founding of the Bank of New York in 1784 and the First Bank of the United States in 1791. The Federal Reserve System, created in 1913, further transformed American banking by aiming for financial stability and central oversight. Evolution of banking. The 19th and 20th centuries brought rapid technological changes to banking. The telegraph and telephone revolutionized communication between banks, setting the stage for innovations like wire transfers. The latter half of the 20th century saw the rise of ATMs, electronic payments, and online banking, making financial transactions faster, more convenient, and accessible. Today, the banking world is globalized and digitalized, with innovations such as digital currencies that ancient bankers could scarcely imagine. This thrilling evolution showcases how banking has continuously adapted to meet the needs of its users, shaping the financial landscape we navigate today. What changed in the banking industry during the early 20th century? The banking industry has undergone dramatic transformations over the centuries, evolving from sacred temples to cutting-edge financial technology. Early 20th century breakthroughs in computing and communications fueled a dramatic expansion of banks, both in size and global reach. Despite this growth, the industry faced severe trials, including the dramatic financial crisis of the late 2000s, which saw the downfall of some of the world's largest banks. How did the Great Depression affect the banking industry? The impact of the Great Depression on banking was profound. The 1929 stock market crash revealed the fragility of financial systems, with brokers lending $9 for every $1 invested. Thanks to minimal margin requirements, a market decline quickly spiraled into a crisis. When brokers called in their loans and investors couldn't repay, banks were hit hard. Runs on banks became common as depositors rushed to withdraw their money, exacerbating the crisis. Government measures and Federal Reserve regulations failed to prevent widespread panic, leading to massive bank failures. In the aftermath of 1929, 744 banks in the U.S. shut their doors, with over 9,000 banks failing throughout the 1930s. In response, nations around the world reformed their financial systems, establishing stringent regulations and creating institutions like the International Monetary Fund, IMF, and the World Bank to oversee and stabilize global banking. How did globalization and deregulation impact the banking industry? In the 1970s, a series of small stock market crashes revealed the limitations of the banking laws established after the Great Depression. This prompted a wave of deregulation and privatization, fundamentally reshaping the financial landscape. By the 1980s, the removal of these regulatory barriers spurred a boom in capital markets and expanded banking services. The onset of globalization further revolutionized banking. American banks and corporations began venturing into international markets, giving rise to mutual funds that specialized in foreign investments. This global expansion transformed the banking sector, turning many institutions into comprehensive service providers for both corporate and retail clients. The 1990s saw a surge in demand for these financial services, driven by the growing needs of government agencies, corporations, and individual clients alike. How is internet banking changing the banking industry? In the early 2000s, the banking sector saw a seismic shift. Traditional banks consolidated their operations and expanded into a broad array of financial services. The rise of big corporations entering the financial arena added a competitive edge, offering everything from insurance and pensions to hedge funds and loans. Yet, customers began demanding more personalized and varied services from their banks. The first decade of the 21st century was marked by a surge in financial innovation. Banks explored new financial products and services, aiming to build stronger relationships with their customers and diversify their offerings. This period of growth set the stage for a more dynamic and customer-centric banking experience. The 1990s heralded the blurring of lines between different financial institutions. Technological advancements reshaped banking, transitioning from traditional branch services to online and digital platforms. Today, banking has ventured into the virtual realm of the metaverse, illustrating just how far the industry has come. The 2007 financial crisis, triggered by risky subprime mortgages, sent shockwaves through the global banking system. The crisis exposed vulnerabilities in financial institutions worldwide, prompting central banks to intervene and governments to reassess their economic strategies. Banking in the 21st century. Banking has undergone a dramatic transformation over the past decade, evolving from traditional methods to innovative digital solutions. Today's banks are not just custodians of money, but are data powerhouses, leveraging vast amounts of information to enhance financial services. The integration of advanced analytics has revolutionized how banks manage and interpret data, addressing critical issues such as security, privacy, and fraud. The financial landscape is now a global mosaic, with institutions focusing on extending services to underserved communities. The rise of microfinance, mobile banking, and other inclusive financial solutions is reshaping access to resources in developing regions. This shift highlights the progress from the early 2000s, offering a level of flexibility that was previously unimaginable. Fintech is at the forefront of this revolution, drastically altering traditional banking paradigms. Digital apps have largely replaced physical bank branches, allowing users to manage their finances on the go. The rapid growth of online banking outpaces that of traditional banking, signaling a significant shift in how financial transactions are conducted. For businesses, this evolution necessitates a comprehensive digital and data transformation to stay competitive in an increasingly tech-driven market. If you enjoyed diving into the surprising history of how we manage money, give this video a thumbs up and hit that subscribe button for more captivating insights. Thanks for watching, and see you next time.